welcome to Property Nomads Podcast. Welcome to an episode with Marc Champ of Wharf Financial. I always say this at the end of the episode, but I'm going to say this at the start of the episode. If you haven't already signed up to the Wharf Financial newsletter, highly recommend you go and do that. Link is in the show notes. Marc, pleasure to have you on board again. Before we get cracking, Bank of England rate went up to 3%, etc., etc. We'll talk about that. I just want to run through a couple of things from the monetary policy report from November 2022. And I won't read through everything because it's a long report, but the bullet points or the headlines I made me laugh. So I'll do this in order. So point number one, inflation is too high. It is well above our 2% target. No shit. High energy, food and other bills are hitting people hard. Yeah, again, no shit. Unfortunately, that's the case, and that's going to continue for a while. And this is the only other point I'll read here. If high inflation continues, it will hurt everybody. Again, no shit. Not actually sure what they're trying to achieve with that. To me, that's quite obvious. But yeah, all of that being said, Bank of England increased rate to 3%. I think we're on our targets that we set at the start of the year. We're on target for. Yeah, what's the mortgage reaction been like? Because and the reason I say that is, although they're not the most reliable source of information, you read stuff on like BBC, etc., and they're saying that a lot of options for maybe first-time buyers, they're tightening up. Banks becoming ever more stringent. What's your experience been in the last few weeks here?
So the banks that we deal with, the rates have gone up. We've seen them go up massively, and they've jumped up much more than the base rate. This time last year, base rate, whatever it was, 0.25, 0.5, I don't know exactly what it was, but it was down there, and your buy-to-let was at 3%, something like that, on the specialist front. You're now looking at anywhere between, I think the cheapest is around 6%, and it goes all the way up to 8.5%, depending which lender you use. So that is a big jump from 3 to 6.5, at least 7%. That is a big jump. It's a bigger jump than going up to where the base rate has moved. So there's been an extra buffer created recently in the rates increased by the specialist lenders. And I think I've mentioned this before. The reason for that, in my opinion, is a little bit of protection, but I think it's also to manage their workflows. The amount of deals that have come in to the lenders in these times it's crazy. It's an unprecedented level. You see more and more people needing to refinance who weren't on fixed rates, or whose fixed rates have come to an end, who need to do things quickly. You've seen people breaking fixed rates so that they can keep their rate relatively low, because the expectation is base rate is going to go up to 5 to 6%, somewhere around there. And nobody knows where it's going to finish. But the recent school of thought is that base rate may not go up to where people have predicted. And the reason is because the inflation will be curbed by the way the rates are moving. Because there's the energy crisis and the rate increase, money has become less scarce. So when there's less money, you can't pay for things as easy, and therefore the price of them has to come down, hence inflation coming down. So with these difficulties, if inflation does start to fall and it gets back down to the levels, you've actually got a position where it can go too far. So rates would need to drop down to help manage the inflation level the other way. So you need to have a balance, and it needs to be gradual, because what a lot of the time happens is sharp movements are what throw people, rather than the actual norm of a base rate or the average position. So something to look out for. I'm not saying the rates are going to come down anytime soon, but maybe they're not going to be quite as bad as what some people are thinking. The other things to look out for that we're seeing is the stability of lenders. Back in 2008, the stability and the liquidity that was there was it was on much more shaky ground than we see today. The PRA have put in stress tests, and there's different metrics that the lenders have to meet with the risk-weighted assets. They've got to have a certain amount of capital back before they lend it out. That is so much more robust today than it was back in 2008. So the stability should be there for some of the bigger players, but it's the lenders who are smaller and who borrow their money or get their money from a couple of sources that other lenders get them from as well, that are going to struggle. So it's really important when people are looking at whether they're choosing a fixed rate, a variable rate, or go for a bridge at 0.8 or a bridge at 0.85, they actually ask the question, where does the lender get their money from? How stable are they? And it's something that in the industry, a group of us have spoken about. And we are always talking about how we can improve the industry. And one of the things that I've said is that I think lenders should disclose where they've got the money from. And it should be something that people should be able to if they ask the question, have that information readily available. They should also, in my opinion, tell customers what their SLAs are at all points. There should be something you can go on their website and say, this is our SLA. Because those two things are also things that affect the rates the lenders are giving. And it's when you talk to a customer about what deal they want, it's really important that you get an overall picture of their needs and their requirements for a solution. And it shouldn't just be rate. There should be other things taken into account, because you don't go and buy a really fast car that doesn't have a good safety rating potentially.
Yeah.
It's if you keep going crashing into trees because the brakes don't work very well, it's not a good idea. So you get something that's fit for purpose, fit for what you want it to do. So it's really, really important that people consider all aspects, because it's at this time, this is where relationships matter more than the transaction themselves, and taking the advice from the professionals, even though a lot of economists don't know what they're talking about and usually get it wrong, it is something that people need to talk to people who have been through these periods before. There's been recessions before, and I'm happy to say at Wharf our team are very experienced. I think I'm the least experienced with 20 years. Most experienced being, I always say 42, but for Simon, but he's actually been with us a couple of years now, so he's probably up to 43, 44 years working in the financial sector. So, yeah, you had a short question, but I've given you a long answer of take advice.
That's absolutely fine. That's the joys of doing these episodes and going through this content. And we've said this before, and we'll say it again, that especially in the last 6 or 7 months, it seems like it might appear like we're beating the same drum, but that's purely because the same drum needs to be beaten, because it's important to have this reinforcement. I'm not sitting here saying that you and I have got all the answers and we know exactly what's going on and stuff like that. But what is important is that, when you're not dealing with customers and mortgages, and I'm not dealing with, survey related work or property related stuff, is that we've got an interest in the macroeconomics. What else is going on? How could this potentially affect things? And then how do we in your case, how do you prepare your clients for that and give them the best advice as possible? And for myself, well, what else can I do to prepare for downturns? Because there's always going to be opportunity no matter what's going on.
But it's not, for me, it's not the advice we give, it's the questions we ask. And
okay.
It's about asking the right questions to provoke a customer to either do their own research or consider things that they've either not thought about or not given enough consideration to. Because 9 times out of 10, a customer will come to us and say, I want the best rate. And that is not the way to look at it for most customers. If you said, if you said to a patient going into the doctor, what is the drug that will, make me feel better the quickest, but may not last the longest, it'll be a pretty poor doctor just to go, take this, you'll have 10 minutes relief, but for the next, 5 days afterwards, you're going to really struggle. That's not what we should be doing as brokers or people in the finance industry should be doing. You need to think about it as a long-term gain. And unless you're doing some sort of quick flip of a property, which doesn't happen, there's no such thing as a quick flip. If somebody is doing the tartan turn of a property, it always takes longer, it's always costs more, and you need to plan. You need to plan for, you started a project 12 months ago and you're just about to go, your exit looks very different to what you did 12 months ago.
Oh yeah, 100%.
And you may not be able to get an exit. That's the issue.
Yeah. So moving on to sort of again, I want to get into prediction modes. We'll do that at the end of December, start of January. We'll sort of summarize predictions that we made and do some stuff for next year as well. Obviously, as we recap, Bank of England rates gone up to 3%. The base rate's gone up to 3%. You were saying that a lot of mortgage companies have up their rates as a result. Understandable. Then there's also some market data that you've put recently on the Wharf financial newsletters. People starting to probably wake up to the fact that there's, I don't want to say a crash. I said that last year, and it's not quite worked out so far. But there could be a correction, because if less people are applying for mortgages or have mortgage eligibility and so forth, obviously that affects the demand side, and that in turn might bring prices down. And then if lending is tightening up, then there might be a correction on the way. What are your thoughts on that from the people that you speak to and deal with?
I think there will be a bit of a correction. House prices have kept going up and up, and they always will. Over the long term, house prices, in my opinion, will continue to go up because there is a demand and there's not enough stock. And until we build tower blocks that are all over the place, or the population declines, then there will always be an increased demand and therefore an increased price. But there will be times where there's less money available, as we see at the moment, and that will cause a little bit of a reduction or a plateauing of the house prices, and that it will recover. So people, I think, in this world we live in, especially looking at social media, they want instant gratification. They want instant results. So if anything, a slight reduction in price, either be patient until you've got a bit more money, or use it to your advantage. There's always ways to get money and earn money. And some people are in less fortunate positions than others, but you can do things to get extra money and save money, and then be in a better position when the next downturn happens. You don't have to spend your money all at once. Nobody's saying to you, spend it straight here today. There are lots of different type of investments, property investments. There's cryptocurrencies that have come about. Not that I know too much about them or promote them in any way, but just being patient, thinking about what other ways you can create a revenue stream, and then when the opportunity is right, act upon it. Educate yourself whilst there's nothing to do right at this moment, and strike when you're ready, not when somebody else is ready or the market's ready. It's an individual thing, because somebody's downturn is an opportunity, and somebody's upturn is a time of we can't afford it now. It swings and roundabouts. There's always opportunities. Just depends how you look at it.
Yeah, absolutely. I think on a summary note there, it's good to go through the best example we've got on the table at the moment. So we're working with yourself on a refinance deal at the moment, and it's a property that we've not refinanced before. In fact, it's the only one in the portfolio we've never got round to refinancing. And key point in being is, start with the end in mind, know what your goals are, etc., etc. Look at the bigger picture, and without digging into too much detail, from conversations we've had on the podcast over the last few months, spoke about, is it AVMs or AMVs?
AVMs, automated valuation method.
Yeah, I get the letters confused a bit. So one of them, and obviously working with yourself, working with your connections, we've been given an opportunity where Aaron and I had to sit down and look at it, because on paper, in comparison to what we bought the property for and what the AVM said, we're able to take theoretically quite a large chunk of cash out of the property. However, that is pretty much going to negate, because of where it is based in the country, that's going to negate quite a bit of the cash flow of that particular property. However, that's why Aaron and I had to sit down and think about it, is because most of our portfolio is on anywhere between 3.5%, and they're fixed in for X amount of years. This particular one, I'll be honest with you, the interest rate took me back a little bit, but we've had to look at it and go, well, okay, if we negate the cash flow on this property, it's 1 out of 20 plus in the portfolio, so not the end of the world. And then actually, with the chunk of cash that we'll get, how can we deploy that? So can we deploy that by, maybe paying off an investor? Can we employ that by potentially obtaining a new property? I mean, we probably won't go down that route because of market timing and whatnot, but we've thought about it. So it's really understanding, getting a spreadsheet out, looking at the numbers and going, okay, the negative here is we're going to lose out on some cash flow. However, that being said, if we can deploy that capital in a different way, then actually we might not lose out on cash flow, because they will either be able to, say, pay off an investor or sort X, Y, and Z out and actually get that cash working for us and producing a return that way. So just want to give a live example. That's what we're going through at the moment. Again, working with yourself and your contacts there. So far, so good. Yeah. But also understanding what's the end goal here, and are you prepared to take that, that risk, and have you thought about it? That's what I want to get across.
Yeah, and I think in your situation, talking to a broker was the right thing. You're obviously well versed in property, but we'd had conversations about AVMs and how you can, I suppose, use them to your advantage. And it's a proper valuation. It's done by the lender. It's all part of the system. It's nothing untoward about it at all. But just knowing when to do it and what properties to do it on, you can put yourself in the best position. And I think that's what you guys have done. You've seen a way of using your portfolio and moving it around slightly to put yourselves in a position that, if you've got this cash in the background and tomorrow some deal sourcer calls you up and says, I've got this cracking deal. Do you want it? You can go, actually, I've got some cash. Let's do it. And not a lot of people do have that at the moment. So putting yourself in the right position when others are struggling, well, why not?
Yeah, exactly. And this is why, at the start of 2021, I think it was, that's why we made that commitment to try and get as much done and fixed as best as we could, just because, we could see the minute they started handing out loads of free cash, let's say that loosely, you kind of see what's coming down the line.
Yeah.
Now, all of that being said, no, Mark, appreciate that. Say in December, we'll get together. We will look at things that we predicted at the start of the year, sort of, give it a tick or cross. How well did we do? And look forward to catching up with you next month. And again, thank you for your time, and go and sign up to Wharf Financial's newsletter, people. It's very informative. Links in the show notes.
We've also, just so I should say, we've got an ebook launching soon. That people will be able to go on our website very shortly and download that. It's a free ebook, a guide to property investment. So people can go on there. It's just a short book telling people what all the mechanics in the background do. So we've got that, and also we're hosting a property development day. So people who want to move into property development, that's going to be in January, sometime mid-January in London. That will be. So we will let people know more about that.
Yeah, perfect. Well, we can do that in future episodes as well. And whenever you get that link for that ebook, let us know. Again, we'll put that in the show notes for people to go to. Mark, thanks for your time, and catch up with you next month.
No worries. Thank you. Thanks, Rob.